would you do if you suddenly got £100,000? Whether it's an inheritance, a bonus, or just a fun thought experiment, knowing how to put that money to work is key. And today, I'm going to walk you through exactly how we'd invest £100,000 in 2025. This is just about what we'd buy. It's about how we think through building a long-term diversified portfolio. Let's get into it. So this is what myself and Jamie, the other half of this channel, would do. But this is not financial advice. Bear in mind that we're in our late 20s, have a high risk tolerance, and decades of investing ahead of us. This is why we'd go with a 100% allocation to stocks, no bonds, commodities, or real estate investment trusts. We're going with a simple but powerful split. 80%, so £80,000, into a low-cost global index fund, and 20%, so £20,000, into individual stocks that we believe in for the long haul. That balance gives us global diversification and exposure to long-term growth, with just enough room for high-risk, high-reward bets on great companies. Our choice for the global index fund would be the SPDR MSCI All Country World UCITS ETF, ticker ACWI, but honestly, there are lots of good ones out there. Vanguard, Invesco, and iShares by BlackRock all have great global funds. Now, this SPDR ETF holds over 2,700 stocks across 23 developed and 24 emerging markets, which means you're buying a slice of the entire global stock market. Roughly 61% of it is in US companies, with the rest spread across markets like Japan, the UK, China, and India. Sector-wise, you get broad exposure to tech, finance, healthcare, consumer goods, and more. Top holdings include names like Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet, the companies that have driven global innovation and market returns in recent years. The fund charges just 0.12% in fees annually, and it's up over 80% in the last 5 years at the time of recording. Look, it wouldn't be the most exciting part of our portfolio, but it's the foundation. It's a long-term diversified bet on global growth. Now for the fun part. Are 10 hand-picked individual stocks, where we put £2,000 in each. These are companies with strong moats, big opportunities, and business models that we genuinely understand. Now, as these stocks were picked by both Jamie and I don't necessarily own all of them in my own portfolio, but they're all great companies, in our opinions at least. Okay, let's go through them. In no particular order, by the way. First up, Adyen, ticker ADYN. Adyen is the payments backbone for some of the world's biggest companies. Think Uber, Spotify, and Microsoft. But what makes it special is that it's built everything in-house. Unlike competitors who rely on clunky third-party systems, Adyen's platform is fully integrated, which means faster processing, fewer errors, and more control for clients. Its customers tend to stick around because switching payment providers, especially for global operations, is expensive and messy. And the more volume that goes through Adyen's pipes, the more efficient and profitable it becomes. While growth has slowed a bit recently, the quality of this business hasn't changed. It still has a huge runway as digital payments continue to expand globally. It's not flashy, but it's essential infrastructure. We think it will still be growing steadily a decade from now. Then we have Shopify, ticker SHOP or SHOP. Shopify isn't just helping people sell t-shirts online anymore. It's become the go-to platform for anyone building a modern e-commerce business. From solo creators to multi-million-dollar brands, Shopify provides the tools to run a store, manage inventory, take payments, and even advertise. What's impressive is how deeply embedded it becomes in a business once you're set up. It's hard to leave because Shopify handles so much of the back end, and switching would risk disrupting your entire operation. In 2023, it sold off its logistics arm and doubled down on its core strength: software. That move helped it become leaner, more focused, and more profitable. And now it's leaning into AI tools that help sellers work smarter, from personalized storefronts to automated marketing. E-commerce is only going to keep growing, and Shopify is perfectly positioned to grow with it. Not by competing with marketplaces, but by empowering businesses to run on their own terms. Before I get into the third stock, I just want to say, I know that I probably seem really confident about investing, but that's not always been the case. In fact, at the start of my journey, I was just throwing everything at the wall and seeing what sticks. And that resulted in mistakes that cost me thousands of pounds. But I've come out the other site, and it is why myself and Jamie created the step-by-step investing roadmap that we wish we had at the start. We've had over 2,000 people take the course, and I really hope it will help you take that next step in your investing journey too. Sign-ups reopen very soon for a limited time. You can join the waitlist via the link in the description of this video, or you can simply head to our website to learn more. Okay, now the third stock is Amazon, ticker AMZN. Amazon is no longer just the place that you buy stuff. It's a logistics empire, a cloud computing giant, and one of the biggest ad platforms in the world. Every time you see a product ad on Amazon, that's a high margin revenue stream. And it's growing fast. Then there's AWS, its cloud computing arm. It's the backbone for companies ranging from Netflix to government agencies. While it's matured a bit, it still drives billions in profit and helps fund other parts of Amazon's business. What we like is Amazon's flywheel. More sellers lead to more products, which leads to more buyers, which attracts more sellers, and on and on and on. It's built a fortress of scale that's hard to compete with. And now the stock's finally being rewarded for its earnings, not just for its revenue growth. We think it has many years of steady compounding power left. Number 4 is ASML, ticker ASML. This is one of those companies most people have never heard of, but it's absolutely critical to the modern world. They make the machines that make the world's most advanced semiconductor chips. There is literally no substitute. If you want to produce the chips used in iPhones, high-end graphics cards, or AI data centers, you need ASML's extreme ultraviolet lithography machines. And they're not cheap. Some of these machines cost over $200 million each. And it's not just a pricing power story. ASML has deep relationships with the likes of TSMC, Intel, and Samsung, and a backlog of orders years into the future. Chips are in everything now: phones, cars, fridges, even kettles. And ASML sits at the top of the supply chain. That gives it a rare level of control and predictability in an otherwise volatile sector. In 5th spot, we have Axon, ticker AXON. Axon's mission is to make the world safer. It started with tasers, but has grown into a full-stack tech provider for law enforcement. Its body cameras, digital evidence platforms, and cloud-based software are used by police forces across the US and beyond. The beauty of Axon's model is recurring revenue. Once a police department signs up for its platform, it rarely leaves. Not just because it works well, but because the digital infrastructure is hard to replicate elsewhere. Yes, it's a niche company, but it basically owns the niche. It's also innovating fast, with real-time communications, AI-assisted evidence capture, and even VR training programs. If you believe public safety will continue to modernize, Axon is positioned to lead that transformation. Crossstrike, ticker CRWD, is 6th. Cybersecurity isn't optional anymore, and Crossstrike is one of the companies leading the charge in protecting the digital world. It offers a platform called Falcon that uses AI to detect threats in real time across millions of devices and networks. Unlike traditional antivirus tools, Crossstrike's system actually learns as it goes. So as cyber threats become more sophisticated, the platform gets smarter. It's trusted by both big business and government agencies, and it's won massive contracts thanks to its speed and effectiveness. Once installed, companies rarely leave, because doing so opens up risk and switching can be disruptive. With the number of cyber attacks rising each year, we think this is a long-term growth story that hasn't even fully played out yet. The 7th company is Marcato Libre, ticker MELI. Marcato Libre is like the Amazon and PayPal of Latin America rolled into one. It offers e-commerce, fintech, and logistics all under one umbrella, and has become an essential part of daily life in countries like Brazil, Argentina, and Mexico. In regions where banking infrastructure can be patchy, Marcato Libre's digital wallet, Mercado Pago, is providing access to finance for millions. That's a big deal. It's not just selling stuff, it's solving structural problems. There are still risks: inflation, currency instability, political shifts, but Marcato Libre has navigated those challenges impressively over the years. It's grown fast while staying profitable and investing in its own delivery networks and payment systems. If you want exposure to emerging markets with strong fundamentals and real-world impact, this is one of the best businesses out there. The Trade Desk, ticker TTD, is in the 8th spot. Advertising is going through a revolution. More of it is happening digitally, and more of it is being bought and sold automatically through platforms like the Trade Desk. What makes the Trade Desk unique is that it operates outside of walled gardens. It's not Google or Meta. It helps advertisers buy space across the broader internet, especially in places like streaming TV, mobile apps, and news sites. They offer a powerful data-driven platform that helps marketers reach the right people at the right time. And it's founder-led, which we always like to see. They hit a bump this year with a new product rollout, but long-term we think they're well-positioned to benefit from the shift towards more transparent, privacy-focused ad tech. Our ninth stock is Duolingo, ticker DUOL. Duolingo has taken something traditionally slow and boring, learning a language, and made it fun, gamified, and accessible to over 130 million people. Its green owl mascot is iconic, its app is sticky, habit-forming, and easy to love, and now it's expanding into other areas like maths and music, signaling a move toward a broader education platform. What's exciting is how much room there is to grow. Most users are still on the free version. As Duolingo finds better ways to monetize through subscriptions, ads, and new courses, profitability should keep improving. It's an education company disguised as a tech app, and that's a powerful combination. And finally, at number 10, we have Alphabet, ticker GOOGL. Alphabet is the parent company of Google, YouTube, and a range of other bets, but it's the core business that makes this such a strong investment. Google Search and YouTube are two of the most used platforms in the world, generating massive ad revenues with high profit margins. On top of that, Google Cloud is now a serious growth driver and finally profitable. What sets Alphabet apart is its mix of dominance and innovation. On the one hand, it's got cash-rich established businesses, and on the other hand, it's got the freedom to invest in AI, self-driving tech, and other moonshots. It's a rare combination: reliable, profitable, and still full of potential. So there you have it. That's how we'd invest £100,000 in 2025. £80,000 into a low-cost global index fund, and £20,000 split evenly across 10 growth stocks. As always, this is not financial advice, and these are certainly not recommendations. Make sure to always do your own research. Let us know in the comments, how would you invest 100K right now? If you found this video helpful, give it a thumbs up, and I'll see you next time.